first thing we heard from Banner Bank was when their CFO, Peter J. Connor, told us an old bank joke about 363. Bringing in deposits at 3%, loading them out at 6%, hitting the golf course by 3 p.m. Obviously, banking has changed a lot since then, as their average United States deposit rate is 1%, and the average loan rate is 4%. The reasons we see this change are the Great Recession, low interest rates, and industry consolidation.
For instance, in the US, there are about 40% less banks than there were in 2007. And in Banner's region, there are almost 50% less banks.
Good afternoon. We are the Gonzaga University's CFA Research Challenge team, and today we're here to propose to you a buy recommendation for Banner Bank with a target price of $63.10 with a 15% upside based on these three key pillars. The first being Banner's impressive diversified growth prospects, the second being their sound financial strength, and the third being their strong competitive positioning. With regards to our first pillar, Banner's growth, we really see it split into two different sections. The first being their organic growth, and the second being their strategic acquisition plan. With regards to Banner's organic growth, we modeled a 7% year-over-year growth for a 10-year period in our valuation based on these three qualitative metrics. The first being their award-winning customer service, the second being their top-rated mobile banking app, and the third being their strong super community banking model. The second part of our Banner's growth comes from their acquisitions. We believe Banner has a strong track record of strategic acquisitions that they have been able to recognize synergies on. Specifically to note, we would like to call out Starbuck Bancorp acquisition, which allowed Banner to double its size, as well as brought them their current CFO, Peter Connor. Additionally, we'd like to note the Alta Pacific, their most recent acquisition in November of 2019, which allowed them to expand their corporate footprint in the key market of California.
Not only does Banner target banks with great loan portfolios, but they target banks with great people. At first glance, average tenure for an executive team of 5 years may not seem too strong, but a closer look reveals the average industry experience amongst Banner executives is about 33 years. CEO Mark Greskovich joined in 2010 and has led a successful growth campaign, nearly tripling the size of the bank in just about 9 years. CFO Peter Connor joined in 2015 with the American West acquisition and has led some major acquisitions during his tenure. Given his extensive background on both the buy side and sell side of M&A, he has been an integral part of Banner's future growth and acquisition platform.
Clearly, acquisitions are a crucial part of Banner's growth strategy. Given that most of these acquisitions are purchased through the issuance of shares, the potential for earnings and share dilution is of major concern for investors. While we can see significant earnings dilution following the 2014 acquisition of Starbuck Bancorp, Banner has since eliminated those dilutive effects through effectively capitalizing on synergies and executing on a share buyback program. Most recently, Banner just missed Q4 2019 EPS estimates by 1.7%. However, they've actually beat on 6 out of those last quarters, averaging a 10% surprise. The Durbin Amendment requires all banks over $10 billion in assets to comply with stricter regulations on debit card fees. We calculated that this would cost Banner roughly $15 million per year in annual compliance costs, which cut into that non-interest income. However, Banner distributors showed the financial acumen of their executive team through strategically managing their balance sheet under that Durbin threshold until they had an acquisition ready with Skagit Bank, which would allow them to hurdle up to the $12 billion in assets that we believe they would need to scale enough that they would not feel the ramifications of that Durbin Amendment. When looking at the financial strength of Banner, which is our second key pillar, we can see that Banner has been able to retain their net interest margin even amidst significant growth. When reviewing efficiency, while Banner is not leading their group of peers, our research shows that this is heavily influenced by recent spending in M&A, a new loan origination system, a new treasury management system, and their innovative mobile app. Banner is repositioning themselves to be effective at this new and larger scale, and we can already see these investments beginning to pay off with that declining ratio. When reviewing capital adequacy, we can see that Banner has had no problem staying above the Basel III requirements, and this declining trend actually shows that Banner is growing more efficient with their capital deployment, The chart on the right reflects that this appears to be an industry-wide movement.
Our third and final pillar deals with Banner's competitive positioning, which we see geographically with their 178 full-service branches across the West Coast. We see due to their size as a mid-level commercial bank, where they fit right in that sweet spot between a small and large bank. And then finally, within their loan mix, we see it leaning heavily towards real estate.
Banner is among the top 10 banks in both Washington and Oregon with regard to market share. California is their newest market, so they do hold a slightly smaller portion of market share there. However, they do hold a significant portion of deposits in each of the markets they operate in.
Banner's acquisitions has put them into some of the wealthiest counties in the entire United States. For instance, King County is home to 2 of the 5 most valuable companies in the world. California, who holds the other 3 companies, is the 5th largest economy in the world in terms of GDP. We also like the loan portfolio of Banner, which is 80% real estate. Prior to the Great Recession, they were exposed to a lot more risk with the construction and development sector. But as you can see, they were able to bring down their troubled debt as they became more of a commercial real estate broker. Next, we can talk about the risks that face Banner as a bank. The macro risks of a financial institution clearly include the interest rate risk that they face, that being a declining or low interest rate environment. But if you look at the most recent Fed dot plot, you can see that one of the board of governors believes that interest rates will fall in the next year. That, in conjunction with the most recent rebound in business and CEO confidence, leads us to believe that if interest rates are going anywhere, they're going to stay the same or go upwards. The next risk we want to address for Banner is regulatory risk. Obviously, major regulation and banks go hand in hand together these days. And this being a presidential election, we see if a more progressive candidate is elected, then there will be more regulation on the financial industry. Currently, as the betting lines have it, President incumbent Donald Trump is the favorite, but some more progressive Democratic candidates have covered a lot of ground over the past month. Finally, we want to discuss the firm-specific risk, and that is Banner's real estate portfolio. We do like it, but it also is what makes them risky, and that is their exposure to the West Coast real estate market. If the real estate market takes a hit like it did in 2008, obviously it will spell trouble for their financial statements. But in the recent 2020 PwC Real Estate Outlook, they said that U.S. commercial real estate would actually be a safe haven for international investors.
To this point, we've been looking at Banner as a business. Now let's look at Banner as an investment. Banner is undervalued compared to both national and regional peers. On the far left is Banner's current trading price of $55.14. As you can see, they are significantly undervalued in both price to earnings and price to tangible book value. Taking a closer look at Banner's relative valuation in comparison to Glacier Bank, a similar sized bank with similar acquisition strategy, you can see that Glacier is trading at a multiple almost 2 times that of Banner, despite Banner having similar margins and efficiency.
Transitioning into our intrinsic value approach, we forecasted an excess returns model with 5 normally distributed inputs over a 10-year growth period. 2 key assumptions I'd like to highlight are loan and deposit growth at 7% and a cost of equity at 7.35%. You'll also notice that we factored in share dilution as a way for Banner to continue to pay for those acquisitions moving forward. What you are seeing here is the output of our Monte Carlo simulation, in which 80% of results came out above the current trading price. We arrived at a price target of $63.10 through a mix of 60% multiples and 40% intrinsic valuation approach.
So in conclusion, through Banner's impressive diversified growth prospects, their sound financial strength, and their strong competitive positioning, we are proposing a buy recommendation for Banner Bank with a target price of $63.10, representing a 15% upside on the stock. So where banking used to be 363, it is now 6310. Thank you so much, and we'll now field questions.
So you guys kind of had a slide that was talking about interest rates staying flat. Just looking at the market recently, there's like 1 to 2 Fed cuts probably predicted for the next year. How would that affect your guys' evaluation and or profitability for the company moving forward if we did see a couple cuts?
Definitely. Well, we think a major risk, obviously, to all mortgage holders is the convexity risk of when they do lower rates and people refinance their loans, and then banks have to then and forth invest their money back into a lower interest rate environment. Their future loans they would give out from that period forth of a lower interest rate environment would be lower yielding than they are currently, and so we think that would obviously not do as well for them.
And then also, I was looking in the non-performing assets or loans had actually doubled in the fourth quarter of 2019. Do you guys know where that maybe came from? And then do you know if those numbers are close to maybe the Great Financial Crisis or how that kind of relates?
That's a great question. Well, we did not look as much into the non-performing assets. One thing that may have impacted that was the recent acquisition in late 2019. For instance, we saw $7 million in acquisition-related expenses this last quarter. So we think that one potential solution for that would be the integration of the new bank. Although that is a great question, and we'd love to look into those non-performing assets and get back to you on that.
You guys mentioned the acquisition strategy. You listed the timeline on slide 5. You put the purchase price for each one of those. Do you know what they paid, what the going multiple is, like on book or earnings for those acquisitions?
Well, we don't have the official ratio. We know that it was not entirely consistent throughout due to differences in the nature of the geographical regions with the banks, as well as their potential earnings capacities.
Mm-hmm.
We did not have a rough estimate for the overall.
Okay, no, that's fine. And then on slide 20, you guys talked about the real estate loan mix. I guess, how did Banner stack up against their competitors in that regard? Pie chart.
Yeah, well, one of the major competitors we looked at was someone that was seen as kind of like the star child of their regional banks, and that was Glacier Bank.
Mm-hmm.
And Glacier, we know, is involved in a lot of the smaller towns in Montana and their region. And compared to them, obviously, the real estate market they're in is Seattle, Los Angeles, but those areas they're just booming with construction development.
Mm-hmm.
So they're much more heavy that as compared to some of those smaller towns in Montana.
Okay. Gotcha. And then when you guys looked at the comparables, I guess maybe it's in here, I'm sorry if I missed it, but did you do like a comparable valuation analysis, how Banner stacked up against other banks?
Yeah, great question. So how we kind of got into that whole relative valuation, we started with a much larger group of peers. And then we, for even as you can see, there are 2 different groups.
Yep.
So for the national group, we took a few different metrics there. So we looked at interest income, Tier 1 capital, and we rank ordered them by how close they were to Banner, and then created a propensity score after we took all of those together to come up with the top 20 nationally. For the regional group, we did take into consideration Banner's direct competitors. There are some banks in the region that might be bigger or smaller, but we did take into consideration who actually operates in this region and who Banner might directly compete with.
Okay. And so the implicit price there is the average of those competitors? Okay. Thanks.
So with the recent outbreak of the coronavirus, if that pandemic were to, basically get worse, how do you see that potentially impacting your business?
It's funny you say that. We definitely saw this question being asked after last night. We looked over the past 10 major disease outbreaks in the United States and how they affected the S&P 500 and stock prices, and only 2, one of which being AIDS in 1981 and the measles outbreak in 2014, actually lowered stock prices 6 months after. So we personally believe it won't affect Banner's stock price other than just possibly speculation and fears from you.
And as an analyst, I actually never covered the financials, so I'm not that strong in the banking sector. But if you could help me better understand what's like the quintessential interest rate environment for a regional bank. Like, do you want interest rates to just kind of stay flat? Do you want them like post financial crisis where they're crashing, or do you want them gradually? What's the ideal environment if you were the CEO of the bank in terms of the interest rate environment?
I have to imagine that the current interest rate environment is not the ideal environment, especially not after the post-Great Recession, just with how tight margins have been squeezed and how low the floor is until they get to 0. And that's where I believe a higher interest rate is always probably better for a bank. Where that rate is, I'm not certain, especially with how interest rates and inflation have changed today. But I'm curious to see that roll out.
Okay. And my last question is, so I also noticed that their loan loss reserves increased this last quarter due to some agricultural exposure. How should I get my head around what that is kind of going forward? Would that be a headwind, a tailwind? How should I think about that?
That was something I looked at when we pulled up the troubled debt reserves earlier. I chose to go with that instead of the loan loss reserve because if you look at loan loss reserve for Banner Bank, it's near the same levels as it was during the Great Recession. And while it might be alarming, I think for us, it shows that they're much more in control of their operations and more realistic of what their expectations are for their loans and how they're going to perform. More conservative.
Right, do you have a follow-up or comment?
Yeah.
You can keep going. if you
Yeah,
want.
go ahead.
So from a dividend standpoint, yields are so low today. In terms of your guys' kind of forecast for the business and the fact that this recent quarter, the earnings kind of rolled off, what's your view of kind of dividend coverage and their ability to sustain that dividend or increase it going forward?
Yeah, that's a great question. So Banner is actually one of the leaders in the loan industry in terms of dividends. We're currently sitting around 3% annual yield compared to around 2.6% for Glacier. And not only does Banner give routine dividends, we've also put out special dividends on a regular basis. And our model, we forecast the dividend payout ratio to continue to increase over the next decade as Banner begins to mature more. So we believe that we are currently a very competitive dividend value stock. And I believe that we will continue to be so, being that we have increased our dividend 7 years in a row, and our forecasts believe that will continue moving forward.
Do they have room in that payout ratio to increase the payout ratio, or are you talking about just the aggregate dividend?
We believe that there will be room to increase that payout ratio. Right now, Banner has a position of being agnostic between share buybacks, dividends, and acquisitions, all three of which they executed on in 2019. We believe that as they become a more mature bank and slow down that growth rate a little bit through less acquisitions, which will lead to less of a need for share buybacks, they will start to prioritize that dividend even more and grow it more for their investors.
Just kind of looking at their balance sheet and knowing that income expense can be a pretty big burden on some of these banks. Do you have kind of the breakout of what debt is fixed versus floating and what the time period for payback on that, maybe?
That is not a metric that we looked into as much. Most of our expense management research went into the non-interest expense as a result of kind of showing the overall efficiency of the bank, which is fluctuating a lot as they scaled. We did not look as much into that as a result of not only Banner's dynamicness, but also with taking on the different banking approaches that their competitors are requiring. That's something that we'll need to continue to look into moving forward.
Slide 40, you guys, this is, I guess, the appendix, you didn't touch on it, but just the net interest margin for Banner, how did that stack up against its peer group?
Yeah, so I think we have a chart relative to their peer group in the appendix there.
Yeah, it's slide 40, yeah.
Yeah, so Banner's net interest margin, I know we saw it earlier compared briefly against Glacier, in which case it was roughly equivalent to it. When we look here, we can see Banner in the red, and it actually was an industry leader back in 2018, and we see them very closely clustered together, with the exception of WaFd. We can see that they're very competitive in this market, which is especially unique, given that Banner is slightly smaller than these other banks. But as we reflected earlier, the fact that Banner has been able to retain those margins amidst the 25% 5-year CAGR growth is really something that we see optimistic moving forward.
It's just about time, so we're ready to go.
Awesome. Thank you.
Nice job, Brian.
Thanks, guys.
Yes. Nice beer. Oh, yeah, just like.